All right, we've got just over a minute to go. Shout out to that random guy, 62 in the Twitch chat, already checking in. More for, how's it going? And it looks like we might be lagging a little bit right now, so I think I'm gonna try to switch the internet connection really and see. It looks like we are maybe back online now. Let's see if we're back online. Give it a second. Okay, I think we are up and running again. So let me know in the chat. I'm actually going to confirm really quickly. Is the stream up and running for everyone? Can you hear me? Let me know in the chat. But I think this should work a little bit more smoothly tonight as opposed to some of the technical issues that we've been having for the past couple weeks. Awesome. More for it. Thank you for the confirmation. We are going to get this thing started. So welcome back to another weekly, I guess, holiday long week edition of our weekly trade ideas stream. I think maybe we should get a more official name for that. Something that rolls off the tongue a little bit better. I don't know. But for now, we are going to call it our weekly trade idea stock market scan. That probably doesn't sound too great either. But we've got Sierra saying it's not working for her. And it looks like, I think it's working on my Twitch app. I'm going to keep it rolling. If you're having trouble with the stream, I'm going to put the message in right now. Trouble with the stream. Refresh Twitch. All right, so there we go. We are going to kick it off the way that we always do every week with our recap of what we had happen last week. Last week was another really, really nice week for us. We had a 2.04% return. That outperformed the S&P 500 return of 0.63% for a margin of 1.41%. So that is an awesome performance. And again, it's great to have this big of a return. This is a huge return on a week-to-week basis, but at the end of the day, our one individual goal is to outperform the S&P 500. We did it this week. We did it last week. The week before that, barely. The week before that, I mean, we're on a really good streak right now against the market. For a little bit more of a high-level look at how our performance this year so far has been looking, and recently, we've got a pretty good streak of weeks that we've ripped off lately, right? So that was our 17th best week of the year. The week right before that, we had a really, really nice week, and over the past, we've 1, 2, 3, 4, 5, 6, 7, 8 weeks, we've only had one losing week, and that losing week was only a $689 loss. Which has easily been eaten up by the rest of the weeks for a total profit of about $17,500 over the last couple of months, about a month and a half. If we take a look at our performance, most importantly against the S&P 500, and again, the dollar amounts are because we track our trades. We like to be transparent about what we're doing in here, but a lot of this is kind of irrelevant. The number that really matters is the fact that we're up 84.92% year to date. I think a little goal that I have in the back of my mind for the time we get to the end of the year is going to be for a 100% return on the year, but we'll see how that plays out. But again, most importantly, what we want to emphasize is our performance against the S&P 500 this year so far, and we are really pulling away as we head into the last quarter of the year. So we're going to hope to keep up this performance. What we've been doing lately, I think, is relatively conservative, surprisingly enough, even though we're getting some really nice returns. But I'll explain what I mean by that, and we could keep it rolling. And that's a good point. We've got Adam in the Twitch chat saying if we had kept our ANY puts, we'd be at 100%. But hey, we're happy to take the profits. We're happy to take the profits. You guys can make fun of me for my toilet paper hands as much as you would like, because I think on our Discord server when we were talking about it, I said, you know what? I think I'm happy to hold this one. And then I think no more than 5 minutes later, I closed the position out to take profit. So that probably explains best our approach that we had last week as we go from top to bottom. UWMC, not really a change in that one. ICLN, this one was great because it finished above, if we pull it up right here, ICLN, it finished above 2360 or 2350 rather, finally. So the shares that we had been holding on to for a while and for like the last 6 months have finally been called away from us at 2350. Now this isn't that huge of a gain in the scheme of things because we only made 150 bucks off it. But as we had kind of alluded to on previous streams over the last month or two, we really just kind of kept holding on to it to prove a point, if anything else, because we always say, look, you could lower your break-even price week after week after week after week. And eventually it's going to catch up to the stock price. Now it might take a while, but in theory, the break-even price can continue to be lowered every single week. The stock price can't go down forever. So with ICLN, we jumped in on this one. It was trading at $27.10 a piece back on February 22nd. So that was a little while ago. That was about 7 months or so ago, I think. Yeah, just under 7 months ago. And since then, it dropped 12.92%, which for some of the more volatile names out there, that's not huge, but this was a clean energy ETF. So that kind of movement is pretty big in the scheme of things for that kind of a stock. What happened though, we just kept chipping away. If you look at our break-even price in the formula box right here, you could just see as we lowered it week after week after week after week, cents by cents by cents. And eventually we collected all of this premium, which outpaced the loss on the shares. And we have Sleepy Condor in the Twitch chat making the astute observation of, you have to watch the sunk cost fallacy and opportunity cost when doing that. Because objectively, like I said, this one was more so just to prove a point that we could turn any play into a winner. But if you start looking down the back end of this, the premium really was not anywhere near as nice as it had been on the front end of the trade. So, if I had a larger position in here, I probably would not have kept holding on to this. But as you can see up here, we had, less than 2% of our portfolio invested in it. So I was perfectly fine with just letting it sit at the back of the portfolio. And eventually, our break-even price was $23.13. It got called away at $23.5 on Friday afternoon, resulting in a $111 profit after all that was said and done. And that's a 5.46% return on this capital that we have invested, which over a 7-month period, or between 6 and 7 months, gets us to a 10.55% annualized return. So theoretically, that 9 to 10% return that the S&P 500 gives every year, this still kind of outpaced that. So despite how boring and how terribly this one went for a very long period of time, we still were able within a 6 or 7 month period to get this thing back to a position where it, gave us a decent annualized return. So yeah, like you're saying, John Michael 1013 in the Twitch chat, it was, more so for educational purposes. And for those of you in the chat who are asking and saying you were hoping for a video today, apologies on that one. It's been a super, super busy weekend for me. I took a red eye last night to get back home, and I was a little bit busy today. I actually just got home after being out of the house all day, so a very jam-packed holiday weekend. So it was nice to get a little bit of a break from things, but I'll be back on the grind. We're going to be getting into it tonight. I'm going to be trying to put forth some more videos this upcoming weekend when I get some time to put that together. And for those of you who are looking for some new content, we at least released a part 2 to our scanning video series. And, Sierra's making fun of me in the Twitch chat saying lifestyles of the rich and famous. But at this point, I think I am neither rich nor famous. So, maybe one day, but definitely not even close right now. But getting back down the list for the recap on the week, Corsair was one where we jumped back in. We were familiar with the typical behavior of that stock, and we could pull it up here really quickly to illustrate what we were going for with that position. As you can see, there's this big spike up right here. If we zoom into the 20-day, it might be a little more apparent. And the implied volatility plotted right here on the blue line makes this a lot more apparent as to what we were doing. It was more of an IV reversion type trade again. For those of you who are unfamiliar with that, it's something we do a decent amount of times on this, where it spikes up, implied volatility jumps up, which means that option premiums also spike up. And implied volatility is one of those things where, what goes up must come back down. So when this comes back down, it also comes with a decrease in option premium. So even though the stock jumped from 27 to 28, almost 29 at one point, back on August 30th, we were still able to sell decently far out of the money puts at a 25 strike for 63 cents of premium. which worked out really nicely. And then when it leveled off and implied volatility dropped back down, we were able to close those out for 34 cents a piece. And I think one thing that might be really helpful to illustrate this is if we go to these 25 strike puts, which are now trading for even less, right? 10 or 11 cents a piece. But if we go to more info, we go over to TOS charts and plot side by side. There you go, right? We could see if we put these on the same time frame here for the 20-day time frame and actually try to line these up. There you go, right? You could see that there was this spike right around here on August 30th, which corresponds to what was happening right here with this big green wick where it went up to, 65 at the peak. And to be quite honest, decently lucky that we got in at 63 cents. That's about as good as the timing could get right there. But theoretically, when the price of a stock goes up, the price of the option should go down. And that's what this purple line right here is illustrating, the theoretical price of the option. So for an IV reversion play, what we're really trying to go for here is when theoretically the option price should be going down, but the price action is counterintuitive and it's actually spiking upwards. So that's what we had right there. A spike up in the price caused a spike up in the options price. And once that IV died down, as you can see in the blue line right here, that option premium quickly died off. And once it leveled out, we were able to close out for about 30 cents a piece. All right, and that is what we did with that one. IPOF was actually a pretty fun one as well. We cashed out for a $200 weekly profit on that, but I think we could have gotten a lot more if we held on tight. Let's go back to one big chart right here and plot IPOF to see what happened there. I mean, our big plan on this one was to, buy an option that was in the money where there was not a lot of extrinsic value. Hold tight, wait until September 17th, and see if we could take advantage of a spike. And that is exactly what happened. Now, we did not quite have the balls to keep holding on past the initial spike up to about 10-ish. So what we did is we got out for 14 cents a piece to take a $200 weekly profit. And circling back to the point that we were making in the chat earlier about the sunk cost fallacy, one of those things where I like to evaluate the trades on a week-to-week basis, just because we initially bought these for 40 cents a piece, and it was looking at a pretty decent loss overall in the trade. On a week-to-week basis, I would have been perfectly happy if you told me at the beginning of the week that, hey, these are actually going to come back to life and make you $200. I would have taken that, any day of the week. So I decided not to get greedy, take that money off the table, get that buying power back, and lock in that $200 weekly profit. Now, from what we could see, our initial investment thesis actually went pretty well as it went back up above 1045. I think these are trading now at about, let's see, between 40 and 41 cents. So basically no extrinsic value on those right now. But if we had kept holding, here's a really dumb game to play if you want to regret everything you've ever done. But if we had kept holding on to these for when they spiked up to about 50 cents a piece, that would have been another $900 of profit. But like I said, that's kind of a dumb game to play, so we're not going to do that. We're happy with the $200 we got right there. And like Morph4 saying, everyone's in the Twitch chat tonight. I'm loving it when we get everyone on the chats lively. If you've got something you want us to take a look at when we switch over into the stock market analysis and option analysis portion of this, feel free to throw it into the chat and I'll write it down. We could circle back around to it after the weekly recap, which I feel like every single week I claim will be pretty quick, and then I end up just droning on and on. So also feel free to use the chat to tell me to shut up. But PSTH, one that we know the thesis on, we're going to hold tight. It's trading just under NAV. I think legally the way that that's structured, if it gets executed the way that it has been rumored to be executed, means a worst case scenario. If PSTH dissolves, they're going to be giving out $20 a share on that. So we're going to hang tight with our October expiries and just let that one play out the same way we let IPOF play out. CRSP, one that we've really liked so far. It's one of the, the golden rule we talk about when you sell options is only sell puts on stocks that you'd be happy to own. And CRSP definitely fits the bill on that one right there. So one we're happy to own. There was decent week-to-week premium. We opened another one, I think 115 for next week, which since I have not really had too much time on my computer, I haven't rolled this forward yet. But that's one that we're hanging on to for next week as well. And, now that I'm positive he is here on the stream, we have to give a special happy birthday shout out to JM from the Discord server, John Michael 1013 in the Twitch chat. If you're in the chat, throw him a little birthday cake icon. We got a little champagne going. Jules is the queen of gifts or gifs, however you fall on that side of the pronunciation debate. Good lord. She's the queen of gifts, and I guess now the queen of emojis in the Twitch chat. So happy birthday, John Michael 1013, JM, I guess as we call him in the Discord server. But definitely had to give the quick shout out on that one. Appreciate you spending your holiday weekend and birthday with us. So let's keep it moving and hopefully not put you too much to sleep, and we can get some financial gain out of what we talk about tonight. SPX was one where we saw it was getting a little bit overextended again. If we type in SPX, just one of those that we like to play call spreads on the S&P 500. If we ever see it begin to get overbought, we have plotted right here. But in the interest of time, we're not going to bring our sign. We're going to keep moving. But when you see these big upward moves like this, that's typically our cue to strike. We like to line up areas of support and resistance with high RSI readings, and that's what we had right there. We started small with only 5 of the spreads, but it pulled back nicely by Wednesday, September the 1st, and we were able to cash in $500 of profit on that one. ZEV, I think this was our free trade of the week in the Discord. This one's actually been going just fine. I think it's down to 28 cents now. I'll need to update that for the next week, but I've already locked this in as my quote-unquote weekly performance. ACIU, this was an example of an IV reversion trade that we did that did not quite go our way. And now this one was a loser, and one thing I do want to point out, I guess bragging on ourselves here in the group that we've put together, because these aren't 100% my trade ideas. We get a lot of good ideas going in the Discord server on a week-to-week basis, so I like to give you guys as much credit as I would give myself for a lot of these tickers and trades that we see up here. But this loss that we had right here was our first loss in, we've got how many trades this past week? About 10, 11 that were alerted that last week. The week before we had 14 trades. The week before that we had about 9 that were alerted. This looks like a loss, but if you net these all out for NRXP, it's a gain. Same with FFIE up here. CLOV was rolled to the next week where it was a winner, so we haven't had any losers going back to mid-August. And then MRNA, another one where if you net them out, it's a winner. Wish, if you net these out, it's a winner. So no losses that week either. And you have to go all the way back to Fastly in the week of August 1st, the last time that we lost a trade that we shared. So I think that ACIU makes it one losing trade in our last 30 or 40 trades, and we like to say it's okay to lose because you're going to lose realistically. It happens. You're not going to win every single trade that you enter into. But the most important thing is that you limit the magnitude of those losses. And that's exactly something we accomplished with that $165 loss, which was easily netted out through the other ones that we alerted and jumped into over the course of the week. And to get to the point again about that IV reversion trade, this was one of those, right? We sold a 7.5 strike put on a spike in the stock. So ACIU, and this is a really good example how valuable this type of a strategy is, right? Because you see this big green candle up. Presumably this company had some really good news that came out. So we were able to take advantage of this, big green candle like we talked about earlier, this spike in implied volatility. And when it was trading around this $11 or $12 level, we were able to sell 7.5 strike puts for, where are they? 50 cents a piece, which means that our break-even price would have been right at about 7 a share for a September 17th expiry, which meant that it was really only a 2.5 week trade. And yeah, like Adam's saying in the Twitch chat, it would have been a really close to break-even right now, even if we had just held. So it's one of those things where we got out for a small loss just to, limit our potential risk. But I like to say, our timing doesn't always have to be perfect on this because, as Adam pointed out right now, it's still above our break even. You could be wrong, but a lot of the time, if you're wrong, you could just continue to wait and let your trade play itself out. And a lot of the times, it works itself out and result in profit. And if this bounces at all or holds above 7, what we closed for a loss would eventually mature into a profitable position. But I guess furthering the point that we were trying to make here about the IV reversion, if we do what we did a second ago, where we plot these side by side, and this is the price chart for the 7.5 strike put that we sold. Let's try to put these on a similar 10-day time frame right here. And there you have it, right? On the big spike that you see on August 31st, where is it right here? It looks like it doesn't go before August 31st. But you see this big spike up to, about 60 cents was roughly the price that these options were trading at. And what you're seeing right here is August 31st up to September 3rd last Friday. And, the price of this option looks a lot steadier than what we're seeing reflected in the chart, right? We see a drop from 13 to almost 7, which is just south of a 50% drop on the stock in 4 days. Yet this bullish position that we have right here really didn't lose any money at all. And again, we talked about that purple line earlier, that theoretical option price, where if the stock is dropping super hard, theoretically you would expect the price of a put to go up. But because of this spike in implied volatility and subsequent retraction in implied volatility, even though theoretically the price of these options should have been going up, the already inflated premiums on these helped limit the losses and really made it so even though we had a bullish position on a stock that dropped about 40% on us, we didn't really lose too much ground. And that's what we like so much about these IV reversion trades, because I think above all on stocks like this that are so heavily driven by implied volatility as far as their pricing is concerned, premium trumps all, and we could put ourselves in positions where if we can capitalize on the spike, even if there's a downturn, we'll still be able to get out right around break-even price. And if there's not a downturn like we saw with Corsair, we'll be able to get out with profit. And I feel like more often than not, you're going to see trades that either continue upwards, level out, or slightly go down, as opposed to some sort of sharp pullback like we saw with ACIU. So while even though that one was a loser for us, we still like the idea behind it. The setup was what we typically look for, and we're not going to be discouraged by a loss, because not every trade is going to be a winner. And it's always important that, just because a trade lost doesn't mean that it was a dumb trade. And conversely, just because something worked out for you in the market doesn't mean that it was a smart trade. But, again, this is a setup we look for. We jumped into it. Don't really have any regrets on that, other than the fact that we can't say, oh, we've been perfect the last 4 weeks. But, realistically, that's just not something that happens too often. But limited the loss. Moving on to the next one. Lucid, another example of, a big spike in implied volatility. If we take a look at LCID, they had a share lockup expiry that we'd been talking about on the stream last week, warning against bullish positions, because anytime you have a chart that looks like this, let me pop this one. Let's go back to the one chart here. Over the lifetime of a stock, right? If you have this is why SPACs in particular scare me a little bit, right? Because you have this base at 10. All of these big time investors and institutions were getting in at about $10 a share. So when their lockup expiry is over and they're able to sell those shares, these companies have positions worth millions and millions of dollars. If you have the opportunity to take 100% plus gain on something like that you've been holding for less than a year, you'd be pretty dumb not to take it. So this is some typical price movement that you'll see on a share lockup expiry. As you can see, these big red candles the second, this is 4 a.m. on September 1st, the day of the lockup expiry. There are these huge downward red candles the second these institutions had a chance to sell. But, while the front end of this is typically something you'll see, the back end of this, the rebound, is also something that's typical of a share lockup expiry. So with this spike in implied volatility that we see right here, plotted by the blue line below the chart, we were once again able to take advantage at open because it was elevated. We figured it was going to pull back at some point, and we sold 15 strike puts, which, cruised to a decent profit. And, another one of those where if we had held on to it, we would have made another $100, but we were perfectly happy to exit the trade on the day that we entered for $230 a profit. You're never going to go broke taking a profit. On to the next one, which was SOL for us. That one expired worthless. FFIE expired worthless. SKLZ expired worthless. And, those three right there, cumulatively, were about $835 a profit. And then we have ANY, which is another good example of an IV reversion trade, which many in here probably are going to make fun of me for getting out of so quickly and not being a big believer in the crypto stock world. Full disclaimer, I'll get there eventually. I'll get there. But, this profit right here was pretty tough to turn down. So I'm going to take a quick sip of water because I feel like I've just been talking for half an hour straight. And then we're going to take a look at the chart right here that led to the setup that let us get out for a $540 gain despite a decent pullback in the stock. All right, and I've got my water tonight in a plastic cup instead of my normal tumbler. So I got to be honest, it's not quite as good tonight, but that is beside the point. Is we're going to take a look at ANY. And there you have it, right? If you have been watching for the front end of the stream and seen some of the other setups that we've had for these IV reversion type trades, this is exactly the type of thing that we look for. A big spike upwards in the stock, which has a corresponding spike in implied volatility, which more often than not results in a subsequent decline in implied volatility, which necessitates a decline in option premium. And as option sellers, that's exactly what we're looking for on a trade. So let's again plot this side by side because I think this is helpful. We've got some more calls. I think Billy called it out earlier that he wanted a face reveal. We've got Jules saying she wants a webcam. You know, the offer still stands. If we ever get these streams up to about 70, 75 viewers a piece, I will happily get the webcam. But as some of you also have pointed out, that may be something that is preventing me from getting 70 to 75 viewers and hitting my stream target. And I appreciate that, Sleepy Condor, you know, reassuring me that I don't have to start out shirtless. But I could take a look into getting a webcam for the stream, spice it up a little bit, you know, get my face in the corner right here while we're talking, increasing the production value a little bit. That's definitely something we could look into at some point. I'm not sure how much you guys would enjoy the backdrop of the back of my bedroom, but we'll see what we can work with. I might have to, if you guys throw some webcam suggestions or some streaming production value suggestions in the Discord, I might take a look and see what we're working with. But back to any, we sold the 5-strike put because again on these IV reversion type trades, the best way to take the advantage of these spikes in premium is to go decently far out of the money. And one of the other things that we like to look for is is selling where we perceive there to be at least some sort of support, so that if we do get this big downward move on the back end of a spike, which sometimes is pretty common, we'll at least have a break-even price if assigned at a level that should be decently manageable. So for us, that was the 5 strike. So if we pull this up again, more info, TOS charts, boom, there you go. Let's plot these on similar time frames, 10 days and 10 days. So there you have it. You see the big spike in price on September 2nd, where we could see right here, it went from about 46 to 50, 60 at the peak right there. And again, another good example of this divergence between the purple line representing the theoretical option price and the red and green candles, which represent the actual premium on the option itself. So whereas when you see a big spike upwards, you would expect the price of a put to decrease, such a quick spike upward and spike in implied volatility right here actually resulted in a price increase. Boom, that's exactly the type of setup that we're looking for in this type of a trade. So we jumped in, and even though it dropped all the way back down to $7 a share, I think by September 3rd, which you could see on the chart right here, you know, a $5+ drop between the peak on Thursday and where it closed on Friday, these puts still lost about half of their value. And, you know, side-by-side charts like this, like we looked at with Corsair, and like we looked at a little bit earlier with some of our other IV reversion trades, this is the exact type of setup and that type of cushion. And, you know, sometimes when the going is good, it almost feels like the profit is inevitable with these kind of odds that we have set up right here. But this is exactly what we like to look for. But again, we got to the point where, you know, for me personally, if it hung up around this 9 or 10 level, I would have been perfectly happy holding on. Such a sharp drop when I believe they announced an offering. So a little bit of a tough break there. Hopefully for those of you that are still in on that, an offering at the market around these price levels will at least stabilize it above that 5 max profit level that we previously had. But for me personally, that big of a drop off and having the opportunity to take profit off the table, right? So we were in a neutral to bullish position when the stock was at about $10 a share, and we put ourselves in a position where we, you know, despite that big drop that we see in the stock on our neutral to bullish position, we had $540 in unrealized profits. So I said, hey, we're taking that off the table. We're going to add that up with the other stuff that we've taken off the table and add it all up for a very, very nice week where we came away with just over $3,000 of profit on what all in all seemed to be, and you guys feel free to disagree, but seemed to be some relatively low stress plays. And, you know, stress is pretty low when you have things drop this fast against you, yet you're not seeing any red in your account. And these are setups that we love to play, setups that we're going to try to target, and something that I definitely could probably do a little bit better at finding. We just got to figure out a good way to fine tune that scanner. Right now, we've got one that if you go to the scan tab and you could load these in from our website, and where is it? It's the one I didn't click. There we go. Go to personal, IV reversion. You know, we've got some right here, right, where we're targeting decent ROR that's really far out of the money with some sort of volume and bid. So that way we could get these high flyers, because the idea is that if something spikes up, that options super far out of the money are going to give some sort of return. So that's what we're looking for right there. But there are definitely, at least hopefully, some better ways to fine tune this that I'll figure out. The main thing that I'm looking for is some sort of divergence in the price action between the actual price of the stock and then the purple line that we've got right here. So with that said, that is going to be the end of our weekly recap, which again, as I mentioned earlier, I feel like always, I claim it'll be nice and quick, but there's always so much to talk about, because we can learn a lot for the upcoming week by taking a look back at some of the setups that we targeted, some of the price action that we saw, taking those lessons from this week and applying it to next week, where hopefully we can have an equally profitable week. So now the big question is, what are we looking at for the upcoming week, and what exactly are we seeing as far as trades that we currently have and trades that we don't have yet, but we're looking to target once the market opens tomorrow morning. So let's get into that part of our stream tonight. And again, if you have any stocks that you wanted to take a look at in the context of an option selling strategy, feel free to throw them in the chat. I will write them down, and we will do our best to take a look at every single one that gets thrown in there. But as far as what I'm carrying over to next week, UWMC, yes, that's just a super long-term trade with a really nice break-even price, so I'm happy to let that one sit as long as it needs to. We renewed our positions on Clover, 8-strike puts. CRISPR, I think we bumped it up to 115 strike puts. And then we also rolled forward the FFIE, 8.5 strike puts to the next week. And this is another super interesting one that I want to take a look at. This kind of is a little bit in the same vein as this IV reversion type stuff. Now, we love FFIE because this thing has been showing some serious premiums for us over the past few weeks, right? If we take a look at our profit tracker, I mean, this past week we sold them for 19 cents, and we pulled $190 of profit. The week before that, we sold some for 21 cents. We made $315 of profit. And we were on it the week before as well for about another $200 of profit. So 3 weeks in a row on FFIE, it's pulled us about $200 a week. So we were happy to have that opportunity to go back to the well again. And what we liked about these so much, not so much that I think it's a great company and is going to be super successful, but the great part about FFIE is you could go decently far out of the money and get some really nice option premium. And I think we sold these for the upcoming week. 8.5 strike puts expiring September 10th. And I believe we were able to sell those for about 15 cents a piece. And the great part about that is when we did that, it was right around $10 a share. So, if we sell an 8.5 strike put, first of all, this red line that we have right here is our max profit level. So as long as FFIE over the next 4 trading days stayed above a price that it hasn't even touched in the last 10 trading days, we were going to hit max profit on that. And I feel like when you outline that trade in plain English and explain what it actually means, it is a really nice value proposition. And the fact that we got 15 cents of premium on that means that if we remove this bottom drawing right here, our break-even price is going to be $8.35. So the top line, everything above this, we're going to hit max profit. Everything above the bottom red line, we're at least going to break even or make some sort of money on the trade. And that is a really good looking value proposition. So I'm happy to keep going back to the well at that 8.5 strike level. But I guess a little bit of a segue, this wasn't an opportunity at the point that we entered into, because I believe we entered early afternoon. Full disclosure, I had a little bit of a flight, so I had to get the trades off before I was in the air and lost internet connection for the rest of the trading week. So I fired them off right in this $10 range. But we have all of these conversations about the IV reversion strategy. And here we have it on a stock that we've been watching for the past few weeks. There was a big spike at the end of the day, up past 10, up near $11 a share. And you could take a look at that implied volatility and deduce that this is probably exactly the type of thing that we're looking for. And what's really interesting is that we sold these for, 15 cents a piece. If we look at the chart for the 8.5 strike puts that we have for the upcoming week, and we right click it, more info, TOS charts, 2 of them right there. And again, let me put this on a 5-day timeline. What's interesting is you'll again see this divergence between the theoretical option price and the actual price of the option itself, right? So we see this big spike upwards on Friday afternoon from 10 to 11. meaning that, theoretically puts should be losing value because the price is going up. But there you go. That same window around 3 p.m. on Friday, these puts that we were selling for 15 cents a piece actually spiked up to about 30, and it looks like 35 cents a piece at the peak, despite the fact that the trade moved in our direction. So this actually was an unintended IV reversion opportunity that, had we had some internet access, I would have been happy to jump back in on. But I think a lot of the guys and girls in our Twitch chat were able to get in on this, hopefully for a little bit higher than what I got. I think I remember seeing some 20, 25 cent entries on that. So I think those set up really nicely, especially with the continued upwards after hours movement. If this levels out anywhere above 10 over the next 4 days, we should see this premium drop off pretty quickly. But that's one that I'm going to be perfectly happy holding until the until expiry come Friday, because I wouldn't hate assignment below 850, and I think a drop to 850 from here, with how steep of a drop that would be, would also breed some increased premiums on the covered calls that we would be selling on the second side of the trade. And I think, CLOV, FFIE, CRSP are really the only three positions that I have headed into the upcoming week. And as we can see right here, we have a ton of buying power free. Actually, these three are gone right now, so we could put 0, 0, 0, same thing over here, 0, 0, 0. These are no longer being held by us, so these all are 0 going down the line. So if you actually look at the trade, ZEV is carrying over, PSTH, all this up here is carrying over. We really only are using about 20% of our buying power as we head into the upcoming week. So we have a ton of firepower on the sidelines waiting for some sort of pullback, if not in the overall market, just in some individual stocks for some better entry opportunities. But this amount of buying power that we have is a really nice luxury, so we don't want to go crazy Tuesday morning, enter into a million positions, and all of a sudden be at pretty much our risk tolerance for the week right there. We love this amount of flexibility. We've had some really nice performances over the past few weeks, and we want to keep this up, to be honest, right? Because right around here, our philosophy switched to be a more conservative one, because for those of you who have watched our streams before, we like to point out what the chart's looking like on the S&P 500 index, which we like to use using the SPY ETF. And if we back this out to, the 1 year chart, it is just super, super overextended in my opinion. We could remove this line right here, and now we could finally plot the RSI study below the table to give some actual numbers behind the idea that things are getting relatively overbought, right? So you'll see anytime this gets up near 70, and again, for those of you who aren't so familiar with RSI, anything above 70 on this is considered overbought, while anything below 30 is considered oversold. And we haven't even been really below 50. I mean, it bounces off this mid-range level. We, over the past year, haven't even approached oversold territory. So it's something I'm treading cautiously. I don't want to put all of my buying power in at once, but I do want to take things at a week-by-week basis. If an opportunity presents itself, like it did with FFIE, like it did with ANY, I'm perfectly happy to throw some buying power into trades like that. But, for the most part, I do want to wait for one of these larger pullbacks. And I say larger pullbacks, even though on the 1 year chart, what we had back in October of last year is really the only meaningful pullback that we've seen. But if you take a look at the 3 year chart, really it gets a little bit more insane when you take a look at this run that we've been on ever since the bottom of the COVID crash. We could look at the 5 year as well. Typically, you're going to see some sort of decent pullback, and this has almost been a straight line up to me. So that is the reasoning behind us not using a ton of buying power right now and shifting to a more quote-unquote conservative strategy. And thankfully, due to the introduction of these IV reversion type opportunities that we've been outlining and locating on a week-to-week basis, we've actually still been able to make some really nice returns week to week, despite what we would consider a more conservative approach to the market. So that's something we're definitely going to keep an eye on. And one thing that I do mention this in the Discord a good amount, why I like these IV reversion trades, right, is because if the stock market crashes and pulls back, not crashes, but has a decent pullback 4 or 5%, and we see it get back down to this 420 level, a 4 or 5% drop really is nothing for the amount of cushion that we're able to get on these IV reversion type trades, right? We remember that on ANY, the stock dropped 20 or 30% on us, where you're still able to get out with a gain. ACIU, the stock dropped almost 50%, and we had a very, very small loss. So the idea is that these types of trades are a little bit diversified from, the typical long positions that we would take, because they're more or less disconnected from the overall market. So if my buying power starts getting absorbed by these IV reversion trades, I'm not too worried about it because their correlation to the overall market is relatively low. So if we see a pullback in the S&P 500, I'm not terribly worried about these trades because they inherently could take and handle a pretty large pullback themselves. So when I talk about concentration of my buying power, I'm really more worried about what we have up here near some of these safer trades, where they're a lot more tied to the S&P 500. And that's why we really don't have a lot of these on right now. Really low amounts of buying power tied up in these, and low amounts of buying power tied up, period. But, that should kind of close the loop and explain our current approach to the market on a week-to-week basis. I'm kind of itching for some sort of pullback because selfishly, I think I've also mentioned this before, it gets kind of crazy when you continue this disciplined approach to the market and then someone pops in and turns $2,000 into $100,000 because they've just been blindly buying calls. And while that might work sometimes if the market's moving up in a straight line like this, that's not always going to happen. That's not sustainable. The big thing that we're aiming for with our approach and the strategies that we teach on these streams and on our channel is that we want to be living to trade tomorrow. We target small gains that compound into nice gains, and most importantly, we target sustainable gains. So how are we going to do that for the upcoming week, right? We talked about FFIE. We talked about rolling CRSP forward, CLOV. Those are all stocks that I'm comfortable, following me the golden rule. I'm comfortable taking assignment of those stocks at our adjusted break-even price. So what are we going to look at for the upcoming week? And a great place to start for trade ideas is with our scan, right? So if we go back to load scan query, go to personal, high ROR puts, we could do with and without earnings first. So let's do high ROR puts without earnings, because a lot of the times you'll run the high ROR put scan, you'll look at something and you don't know if it's inflated because, there's just a big premium, or if it's inflated because they have earnings upcoming. So this one, thankfully, filters out those earnings for us. We could run the scan really quickly and see what we've got cooking for the upcoming week in the market as we patiently await the results. So there you go right here, some big premiums right here. And for those of you who are not familiar with Thinkorswim or have Thinkorswim and want to start using some of these option scanners, if you go to load scan query personal, you could actually download the exact option scanners that we use, quick shameless self-plug right here, over at our website. If you pop over to hourglass-trader.com under the HT Premium tab, you're going to have our, let's see where to go, our option scanners right here, and there are going to be links for you to import all of those into your Thinkorswim module so you could run the exact same scans that we are running on this stream right now. So back to our regularly scheduled programming. 21% ROR on a week-to-week basis is enormous, but for those of you who have been following SPRT, and we made a little bit of money off it a couple weeks ago, I mean, this is a hilarious looking chart. If we zoom that back into the 180-day, huge spike. I mean, these stocks, or excuse me, the options have strikes of 21 and a half to offer that much premium. You might say, oh, I'm going to aim for a 21% return in 1 week. And this would have roughly a 16.5, 17 break-even price. But the big question you want to ask yourself is that golden rule that we just referenced. Do I want to own this stock at a $17 basis? And the answer to me is, absolutely not, because this thing over the past 180 days has traded around $2 a share, spiked up to 8, fallen back to this, 4, 5, 6 range. And then it, ran up to 10. And at this point, it's funny, right? Because when you look at the 180-day chart, it looks ridiculous and it looks like nothing happened before. But if you actually looked at this section, that looked like a pretty big squeeze itself, but obviously paled in comparison to what was happening on the 180-day chart with that big spike that they had on August the 27th. But long story short here is, our option scanner is a great place to start for trade ideas and forming, trade theses. But just because something is on here doesn't mean that it's a good investment idea. And reminding yourself of that golden rule, would I want to own the stock at the break-even price that this cash secured put would give me? That is something you need to be reminding yourself. 17 is not a remotely attractive break-even price. Something back down in this range, maybe. I mean, we could take a peek really quickly to see if there's still some decent out-of-the-money premiums. but it really doesn't look like it. I mean, you could 13s if you really wanted 13s, but again, I don't think I would want to own this stock around 13 because that's still way, way, way above any sort of support that we could see on the chart right there. So yeah, I would personally leave that one alone. But hey, if you're someone who says, I'm fine to roll the dice a little bit, I'd be happy to own it at this price. More power to you. Give it a shot. Back to the scan. As we outlined in that YouTube video for scanning, we uploaded that part 2 option scanning YouTube video where we talked about some of the rules that we like to look at. One of the other big rules that we outlined for ourselves in the context of option scanning is that we typically, as far as this strategy is concerned, we're going to want to avoid biotech stocks. And SAVA is a biotech stock. And, this kind of insane price movement from 6 up to 130, back down to 30, up to 150, back down to 50 is always inherently going to bring some serious premiums. And every time something like this happens, without fail, in our Discord server, people will say something like, hey, SAVA has got some really good premiums. What do we think about that? And we had this question when it was trading at 120. We had this question when it fell back down to 80, and we said, hey, it's fallen down pretty far. Premium's pretty big, so should we sell some? And to me, in the biotech area, that's not somewhere that I typically want to get involved because as big as these upward spikes can be, the ensuing red candles can be even bigger. And, we talk about how we could continually lower our break-even price on a week-to-week basis. If we have such a sharp drop-off in price, it kind of renders our strategy relatively ineffective and makes it a lot tougher to sell options near our break-even price to accomplish that goal of knocking some meaningful dollars off of our break-even price for a stock on a week-to-week basis. So that's why we like to avoid biotech. SPRT, SAVA, I would stay away. AMC, I know we've got some serious AMC fans here in our on the stream tonight in the chat because we talk about it a lot in the Discord server. I personally do not like to get in that one because I think there's some serious downside risk there, but our resident AMC expert, Jules, and some of her, I guess we'll call them her AMC associates, would be happy to talk about that one. There's more for shouting out AMC. I'm sure he'd be happy to talk about that a little bit in the Discord server. But, that one, not for me. TTCF is another one that came up in the server this week because seriously big premiums. They just introduced weekly options, which again, we love to see weekly options because they provide us with a really nice amount of flexibility in managing our positions on a week-to-week basis. So if we pop back over to the chart though, again, remind ourselves of that number one rule, right? Do we want to own the stock at the price that we'd be selling these puts at? And you might look at this 180-day chart and say, you know what, I'd be okay with owning this at about $19 a share because it's bounced off it back in March, bounced off it back in March again. It bounced off it in the back end of July. So, conceivably there could be some sort of support at this $19 level. And then you could take a look at 19 strike puts for the upcoming week and say, hey, 0.66% return on risk. That's not too bad. And for those of you who are new, I'm going to do this exercise again really quickly because a lot of the time when we bring up the fact that, hey, a trade has a 0.66% return in 1 week, people say that's a really small return because they come from an option buying background where you're targeting these enormous gains on a day-to-day or week-to-week basis. So to put it in context for you, if we go to tools, the annualization calculator that we have on our website, we pick out a 1 week trade, right? We'll put 1 week in as the time frame and we get a 0.66% return. That's a 40.92% return on a year-to-year basis, and that is going to be crushing the S&P 500. You are going to be dominating hedge funds, and you are going to make a very nice living for yourself if you're able to pull that off consistently, right? So if you had like a $15,000 account and you pulled 40% every single year, by the end of year 5, you're coming up on 6 figures. So again, a 0.66%, you might say, that's really not that big. I would just encourage you to think back to this example that we're showing right here. And remember that even just a 0.66% return is 40.92% annualized. And that is something that we always want to keep in mind when we're setting up our trades and targeting, a specific ROR. The range that I like to target and I think is a decent sweet spot from my experience is about a 1 to 3% ROR. But as we just illustrated, a 0.66 isn't bad either, so I'm not afraid to step out of that range to the downside and go for maybe a 0.5 or a 0.6% return if I like the value proposition on it. But with this said, golden rule, do I want to own this at 19? And the answer to me is no, because if we back this a little further up, we'll see what is the telltale sign of a SPAC, right? A special purpose acquisition company. We see this huge price floor from September 2018 up to about April of 2020. So, almost 2 years, looks like about 18 months of this price floor around $10 a share before, what happened to SPACs, and this thing completely shot up and is now chilling where it is at about $22 a share. But point being on SPACs, and the point that I'll make all the time, so I apologize for those of you who think that I may be sounding like a broken record right now, because I have 100% said this before and I say it all the time. I'm always cautious of getting into a SPAC decently above net asset value. So like we saw with Lucid, right, LCID, we saw that the stock went from 9.6, was up at 20, and then upon the share lockup expiry, there's this huge drop back down to 15. Before, I'll give you credit, it bounced back up. But with TTCF, you're back at 22 right now. You've already had a decent drop from 25. Within the last month, it was down to that 15 level. So the downside potential is definitely there on a stock like this. But, from a broader perspective, what does it mean when a SPAC is trading at 22, right? So as far as the fundamentals of the transaction are concerned, the amount of cash that's sitting in the SPAC is worth about $10 a share. And that amount of cash is put into the transaction to acquire the company through a reverse merger and take them public. That is the purpose, the special purpose of a SPAC, to take a company public via reverse merger. So essentially, in plain English, what this is saying is that upon the date of acquisition, they felt that TTCF was worth roughly $10 a share, because that is the equivalent amount of cash that was used to acquire a portion of the company sufficiently large to undergo a reverse merger and bring them public to accomplish the goal of the SPAC. So what we're saying right now is at 22.08 a share is that, since this was worth 10 a share on the date of acquisition, between, I don't know when exactly the acquisition was, because a lot of the time you'll see a run up before it, but you're saying at some point between the end of 2020 and right now, which is less than a year, that this company has done something to double its value. And a lot of these SPAC transactions are done at really unfavorable valuations in the first place. So, having that type of inflated current valuation as opposed to that 10 a share deal price in an area where deals typically are done at some pretty rich valuations is something that generally leads me to stay away from SPACs that are trading, above 20 when they have a net asset value of 10. Now, if this gets back down to the 13 or the 12 or the 11 area, definitely a great one to revisit, because as we said, decent flexibility on a week-to-week basis with the weekly option chain. And, maybe not the worst company in the world. I haven't done a terrible amount of research on them just because, this didn't quite fit the number one rule for me, where I don't want to own a SPAC that's this inflated from net asset value. So I haven't looked too far into it. But again, one of the areas why we enjoy having a watch list so much, we could just put it on the watch list. We'll put a price target in of about 13 or 14 a share. And if it hits it, it hits it. And we could take a look and enter. And if it doesn't, it doesn't. If it runs away to 100, whoever, whatever. We didn't lose a single cent. And as we always say, it is so much better to miss out on a great trade than to enter into a losing trade. And I worry so much with SPACs at this level that entering into that would put you in on a losing trade. And we've got JM, John Michael 1013 in the Twitch chat saying that it's worth owning. He can vouch for them. So if you are in a mood to not listen to me tonight and you want to listen to the birthday boy, hey, go for it. And if he makes you money, you could say that you listened to him and I led you astray. I give you full permission for that conclusion from this TTCF discussion tonight. But I'm not gonna go against the birthday boy right here. So we're gonna move on to the next one, which is gonna be ChargePoint really quickly, because this is the exact same point that I want to make. Right, this one pops up a lot because there's decent premium on a week-to-week basis. They've got these weekly option chains that offer some decent ROR numbers. But as far as a company I would want to own at a price I'd want to own it at, this still doesn't fit the bill, with this big range from 10 to 50 back down to 22, which mirrors something that we saw previously with Hyliion, where 10 to 60 to 22, and then there was this inevitable painful drop back down below the $10 level. Not to say that that's something that's going to happen again, but I don't think it's outside of the realm of possibility. That was also, these two, Hyliion and ChargePoint, are both electric vehicle industry companies. So, I don't want to get stuck in some deja vu and be losing money again on that. So while I do think ChargePoint itself is a good company, price action wise, and the precedent that's been set by these former SPACs, I am just going to leave those alone and just plug my ears every time they're brought up. So with that said, let's get back to the scan. If anyone has some stocks they want to look at, we could take a peek. And I think we might have had some earlier that I was just doing a very good job of annoying, because every now and then I'll get distracted by the chat and I'll start stuttering and talking over my words, which probably is a really good look for someone who's supposed to be streaming and clearly and concisely delivering you a message. And I could bring this on the screen so I'm just not completely in the dark on what I'm looking at here. We've got Nvax, and we've got Sleepy Condor saying he's going to predict what I said about Nvax. There we go. Too risky because fancy medicines are too volatile. So, I mean, you're probably right. We could take a look at Nvax, though, and take a look at the whole situation that we've got going right here. Nvax, But yeah, in general, this is a pretty big jump. We've got Leo. We got Leo's G1980 in the YouTube chat going for JOBY. We'll take a look at that one up next. Nvax is one that has always scared me. It's kind of been at the forefront of news with what's been going on with COVID, because they developed a COVID vaccine that I think probably at this point it's been commercialized, or else it probably wouldn't be this high. But my biggest hesitation with them when they had this run up from $4 a share up to 150 initially is the fact that in their history, which is a decently large history, they've had a lot of R&D, but they've never actually brought a commercial medicine to market. So that is something that made me want to stay way away from, the hype that was building around this one. We could look at the 10-year chart. I think this company's been around for a while, right? Yes, this even goes back to 2015 and 2016, and not a lot of sustained success. We got Todd Miller shouting out IQ in the chat, and I definitely overlooked that one. I will write that down. We'll get to IQ. Don't you worry about that. But, Nvax, huge jump here. And one of these things where, you've probably had the opportunity. It wasn't just getting into the news, right? They had their initial spike back in 2020. There was another big spike back at the beginning of 2021. We've had a pullback to 150, and it's testing, other than this spike right here, kind of all-time highs again. And what I would ask you if you were someone who is looking to get in on a trade like this is, if you didn't want to buy it when it was 50, if you didn't want to buy it when it was 100, 150, 200, why do you want to buy it now when it's at $250 a share? The risk to reward isn't quite there for me. The whole allure really with the biotech area is that, hey, you could get in on a stock that's trading at $4 or $5 a share. They could have something go to market. They could have some really good FDA trial results. Something really nice could happen with them, and you could get this huge upside on these. But once the upside has kind of already occurred on a relatively short-term basis, and we could pop open the 180-day chart to see that insane upside being realized, what is the remaining risk to reward? And to me, it's just not a very good value proposition. We could take a look at the options, because I'm certain they're going to have some really nice premiums with how much it's been moving on a week-to-week basis, right? You can get a 1.69% ROR at 235 strike, which is right down here, which if you take a look at the last week, I mean, it was already below that 5 days ago, so there's no reason that couldn't pretty easily pull back down. But, Sleepy Condor kind of nailed it. I liked the HT impression he had right there. Super risky in an area I don't typically like to be involved in. And even if I were going to, say go ahead and give the whatchamacallit, the green light on a trade like this, I wouldn't. This just isn't my favorite entry point in the world for something like this. If it falls back down to about 150, which is a decent drop, I'm saying if it falls back 30 or 40%, I'd be happy to take another look at it. But for now, I think the risk to reward isn't there. Don't fall for the trap of going for nice ROR on something where there is just a huge drop below on the chart right there. So that's the down and dirty on Nvax from me. Next, we're going to look at IQ, because I think Todd in the YouTube chat asked about that one first. And then we're going to look at JOBY. So IQ, if I could get this thing to type when I hit the keys. There we go. And it is, let's see, we don't know exactly what it is. I've seen it before, but I don't quite remember. So we're going to go to the Analyze tab and type it in here. Communication services. It is a China-based, red flag right there, China-based company principally engaged in the provision of online entertainment services. Let's take a peek at what the chart's looking like. And again, talking about macroeconomic trends, what's been going on with China and the regulatory, environment over there is really, really concerning. You could take a look at something like Didi, which was supposed to be the Uber of China, this huge rideshare app, pop up in the 180 day. Some huge drops from their IPO. They bottomed out at about 650 a share. Even Alibaba, the Amazon of China, which is this huge powerhouse making tons of revenue over the past 3 years. It's the stock's almost relatively flat thanks to how big the drop has been from the peak of 320 back in November of last year to where it is at about 170 a piece now. But, that begs the question, since this has pulled back so much and kind of like we were getting into with that discussion with Nvax, we don't want to buy up here, right? We want to wait for a pullback like this. Once we see this kind of a pullback, is this an opportunity to get in? And, the big risk beyond that, to me, is we really have no idea what the Chinese government is going to do. It's one of those things where, coming from a more capitalistic mindset that you would use to evaluate American companies, you could easily say something like, the Chinese government would never let their biggest company start losing all this money like this, yada, 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 because something like that, quite frankly, just would not happen in America. The U.S. government would not put the clamps on Amazon or a company like that to the point where they have this big of a drop in their stock and, having this catastrophic of a result due to government regulation. However, that is kind of different in China, and the feel that I've gotten from what I've read online, which, maybe take that with a grain of salt, because I feel like times I've heard people say, I read this online, blah, 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 blah. But the idea that I kind of got is that, the Chinese government is a little bit more concerned with power as opposed to revenue. So they wouldn't be, steadfastly against flexing their muscles on a company like Alibaba if it thought that it made them look more authoritative and, gave them a little bit more power and control in their country. So is that true? I have no idea, but that's kind of the impression that I got reading that. But with that said, that kind of risk is not really something that I would want to take on in my portfolio. I think we can go back to IQ. If you do have that risk in mind and you're aware of that risk and you're okay of, maybe one day Chinese stocks potentially being wiped away from the U.S. stock trading markets, go for it. But I think that is something that I'm staying away from in general. As Jules mentioned, Queen Jules in the Twitch chat, no more Chinese. Hopefully she meant stocks on the end of that. But we try to stay away from the Chinese stocks. And even though these are some decent ROR numbers, again, that 1% number is pretty nice for a stock that used to be trading in the 20 to 30 range. Could there be some big resolution with the CCP, the Chinese government, and this jumps back up to 20, Alibaba jumps back, Didi jumps back, and it's like none of this ever happened? I mean, absolutely. That is something that could definitely happen, but I think conversely, that downside risk is something we really want to keep in the back of our minds, because I don't want to have a significant position in a stock that the next day is at risk of being wiped away from the U.S. markets. And that is something that I think is, is it probable? I have no idea, but I think it's definitely something that potentially could happen. So I'm going to want to minimize that risk. IQ, not to just single out that stock in general, but all those Chinese traded stocks via ADR are something that I'm keeping out of my portfolio for now until there's some sort of better resolution to what's going on over there. The next suggestion we have is JOBY. We're going to take a look at, and then after that, we're going to look at Redfin, RDF, and from Jason Craig in the YouTube chat. So JOBY, what is Joby? And I'm going to assume it's Joby Aviation Inc. So if you've got any more info on that, Leo's G1980 in the YouTube chat, feel free to throw it in and give us some supplemental info as we crack into this one. It looks like this started trading back in November of last year. So I think the 1 year rather is a good place to start with this. Pretty big jump, fall back down to 10. If I had to guess, maybe this was a former SPAC. I don't really know. We can maybe check the news around August to see what happened with this one. There we go. Completes SPAC merger with Reinvent Technology Partners. There you have it. So we could pick these SPACs up pretty easily just from the price action that we see on the chart right here. But again, a SPAC that went up, and it's so easy to get caught up in these inflated valuations of SPACs because these companies that are being taken public are getting hyped up because people want the deal to be executed, and you're hearing all this super good info about these companies. Okay, it used to be PSAC. That's good info. It used to be PSAC. But yeah, that's why I caution so much when we talk about ChargePoint, when we talk about Lucid Motors, when we talk about TTCF. That's why I always caution getting in around these levels, because as quickly as it ran up, it could just as easily fall back down to that net asset value level. And just as quickly as it runs up post-merger, it can just as easily fall back down. But what's really interesting about this one, if we maybe get a little bit closer here, go to the 180-day. How about the 20-day? There's some really insane price action right here, which should bring the type of volatility that we like to look for when we sell options. So quickly, let me plot this implied volatility. RSI didn't look like it was telling us too much. If anything, on the 20-day, it's oversold, so we could expect some sort of short-term relief from there. But let's get that study up there. Quick study, all studies, implied volatility. And there you have it, right? It's gone from about 1.1 up to 1.4. If we zoom out a little further, hopefully that'll give a little bit more color on this. And yeah, ever since the merger, implied volatility has been through the roof. And will that come back down at some point in the near future? I mean, we would tend to think so. So let's take a look at the option chain to see what we're looking at here. First impressions, right? We only have monthly options, so it'll be a good idea to keep in the back of your mind, not just part 1 of this for September, but where we think we could get our adjusted basis come part 2 of this, which would be potential assignment and selling October covered calls. So for September, and typically I'll stay away from stocks like this that only have monthlies until we get into that 1 or 2 week window away from expiration, right? So they expire September 17th. That's about 2 weeks from now. So I think this is a great range to jump in on something like this. What's also really nice right here is you've got some decent some ROR potential right here. 3% in what's going to be 9 trading days, right? Because the week starts on Tuesday tomorrow. So there'll be 9 trading days left till expiry. As I guess this is 11 days. I don't know why that says 11 there, but it could be 9. I guess it's 11 total days, but 9 trading days till expiry. Decent ROR here at 13.31%. And you might say, I want to be safer. I want to go for 3% ROR in 2 weeks, and that's perfectly valid right there. And we can get into this ROR versus ROC conversation as well, because fully cash secured, we know that selling 10 of these would, or I guess we could say selling one of these would take $750, but it looks like 33% margin buying requirement, right? So typically, if we pull up here's the debut tonight of our beautiful system calculator, we know that $20 divided by the 730 max loss that we have right here offers that roughly 3% ROR, and this is calculated using a price between 20 and 25. Whereas we used 20, so that's the discrepancy that you see between our 2.7% and the 3.09 that they have outlined there. But, what is a 3% return on risk starts to look a little bit better when you look at return on capital, which is your return divided by the amount that's actually required to be collateralized as part of the trade right here. So that $20 of profit, instead of dividing it by 730 for being fully cash secured, we could divide it by 242 for return on capital. And that sticks you with an 8.26% return on capital for 2 weeks. And, we don't even need to go back to the annualization calculator to know that's a pretty nice opportunity right there on JOBY. We could plot it out right here knowing that 750 level is going to be max profit. 749, close enough. And if we pull it into the 1 month, right, it's decent cushion for 9 trading days. It's never been below 825. That's the low. And with 20 cents a premium, if we can get that at open tomorrow morning, sticks you with the 730 break-even price, so there's not a ton of separation between these two lines. But that's the situation right there, right? You can fully cash secure, get a 3.09% return, which is good. Or if you want to use that leverage, that margin buying power privilege that your broker may or may not grant to you, you could stretch that out into about an 8% return in 2 weeks, which is very, very nice. So that might be something that we look into. But more interestingly, potentially, is what happens if we were going to go for these 10 strike puts? Let's plot these out really quickly as well. So from a cash secured put perspective, and if you were super bullish on the stock itself, These 10 strike puts are great because they put you at a max profit point right about here, which is pressing up into it. Like, it gets a little bit closer than we like. But as far as as far as our break-even price, there's going to be a little bit bigger separation between the two red lines here because that premium is about $1.15 a piece, meaning your break-even price is going to be $8.85 on this one. So let's draw that second red line, $8.85, close enough. So there you go. For the next, got to right-click on the line, extend to the left, and extend to the left. So if you were to go the 10 strike put route, fully cash secured, you'd be pulling a 13.31% return. And let's quickly check on the ROC if we sold these using some margin privileges. Looks like only about 50% privilege on those right there. So not quite as good as the 7.5s as far as ROC is talking about, but you'll get roughly double that. You'll get about a 20 to 25% return on capital if you choose to use that and have that 115 return divided by 492 of capital for just one of them. So you could take that approach, a little bit bigger risk, a little bit higher reward. But again, important to remember that even though it's 50-50 on whether it finishes above the max profit point at 10, you still have a decent cushion thanks to that 115 of premium it has. So to be honest, I don't think you could really go wrong either way with this one. I think potentially trying to maybe jump in half and half, right, with some 10 strike puts for about $1.15 and see if you can get some fills on the 7.5 for 25 cents come tomorrow morning. That could be a really interesting trade, and I think that's one that I'll have on my radar and see if I could enter into. But before we close the lip, it's getting to that time of the stream where I start saying words that I am not looking for and stumbling over my sentences. So we're gonna stay strong for the last part of the stream. There it goes again. Sleepy Condor saying we better annualize that. I mean, that would be quite the number if we annualized 25% over 2 weeks. But to avoid making my frail computer crash and have to shut down the stream because of that, I'll probably avoid that. But the last thing I want to do is take a look at the live news right here, making sure that there isn't a huge reason that the stock dropped so much, rather, right? Because it was down 14%, and it looks like we have that news right here. If I click it, pull it back onto the screen, the shares are trading lower after the company filed for the resale of 427 million, that is, shares of common stock by selling shareholders. The resale of 83.5 million shares issued in the PIPE investment, and the resale of 28.8 shares upon warrant exercises. So, in plain English, I guess cutting through that is to that concept that we talked about earlier with Lucid and their share lockup expiry. This kind of is hand in hand with that. However, where with Lucid, they were selling those at around $20 a share for 100% profit, JOBY is back down around net asset value. And, the increase in sale of the stock should increase the amount of float if those were shares that were previously locked up. So hopefully we'll stabilize the price out a little bit better. We have this short-term increase in implied volatility. If that could drop back down, we could see the premium get sucked out of these pretty quickly. And again, even if we're wrong about all of that, as long as this thing doesn't drop about 15% in the next 2 weeks or the next 9 trading days, those 10 strike puts will hit profit. And as long as the thing doesn't drop 25% in the next 9 trading days, these 7.5 strike puts are going to hit max profit. So I thought that's a really good recommendation. I'm glad we talked about that. And I think that might be one that I look to target come tomorrow morning, depending on what that premium is looking like. So next one we've got, and I think we'll call this the final one right here, from Jason Craig in the YouTube chat. RDFN. We're going to take a look at Redfin. Very similar to one of my other favorite stocks, which is Zillow. I'm going to take a quick sip of water before we round out the analysis tonight on the stream. All right, still not quite as good as that ice cold tumbler water, but we're making do. We can't complain. So Redfin, here's the 1 month chart. We're going to quickly page through these, get a good idea of what price action has looked like. And when we talk about entry points for a stock, I mean, this is, getting to be about as good as it, not as good as it gets, but maybe as good as we have seen tonight. Going back to the 1 year, you start to see some decent areas of support. You could see where it bounced off of about $44, $45 a piece in August. If you plot that line actually and extend it out to the left, it looks like it corresponds with another rebound that they had in September of last year at that same price level. In the one instance that it did break below that, it bounced off low 40s. The bottom was at about 37, but that's not a huge issue to me. We'll go one further back to 3 years. And that starts to get a little bit, it starts to look a little bit elevated on the 3 year, but you have to take into consideration what this company is doing, looking to more so, digitalize similarly to what Zillow is doing, the real estate industry, which is something I think there's a lot of potential growth for. So I think that could justify the big move that we've seen upwards in this stock over the last 3 years. Something else that might be helpful is if we pull up Zillow side by side. Let's go 3 year. And there you go. I mean, these things move very similarly to one another. I'm a fan of Zillow, and since they move so closely together, I don't think there's a reason not to be a fan of Redfin. But maybe we could really quickly let's take a look at the 180s on these. Get an idea of what's been hurt more, right? This is down about 50% from the high. This is also down about 50% from the high. And these things, they're about one and the same. So I don't know if there's too much opportunity for trying to pick one from the other. They're very similar. I like Zillow, so I think, by virtue of association, I like Redfin as well. Let's take a look at the option premium that it offers on a week-to-week basis. And the first thing, again, that we'll see is that it offers it on a month-to-month basis. We've got some decent, 2.63% for a 50-strike put over the next couple weeks. Let's blow the Redfin chart back up. So if we look at the 10-day, this is where that 50 strike would lie. And, not a ton of cushion, right? I like the 10-day chart to look at right now because there are only 9 trading days left. So we can get an idea of the potential range for a stock like this over a 10-day trading period. And, with the base around 47.55, if you sold a 50 strike put, that would stick you with the 48.70-ish break-even price, which is right around here. Not terrible because it's near the lower, or I guess they really only had 2 days in the last 10-day period that traded below that. So from a break-even perspective, this is the one that you're comfortable with holding long. The 50 strike put isn't too bad. I'll just typically, if I were that close to being in the money with the put that I sell, would look for something a little bit bigger than 2.62% ROR. But that also could point to the fact that, the premium on here is not great just because there isn't a big expectation that this thing is going to be pulling back anytime soon. Alternatively, let's take a look at the Zillow option chain where we have that week-to-week premium. If you wanted to go a week out, you could get that 2-ish% number at 95, 96, but kind of the same analysis here, right? Is the fact that they're really in the last 10 trading days at that 95, 96 level. I've only been a couple days where it was below that. It bounced back up. But in the context of what we're looking at the last 180 days, this thing's been pretty volatile. You can see implied volatility has dropped off a decent amount. I personally, even though I really like Zillow, I'm waiting for a bigger pullback in the overall market because I think that is when we're going to see a pullback in these real estate stocks as well. If we go to the 3 year, we get another break back down to this, 65-ish level, and that might be asking a lot because that's a 33% reduction in the price, but if we could at least get back to this high to mid 80s level right in here, I'd be a lot more comfortable going closer to the money than I would be at 97 right now. Now, if this were a situation where the market had just pulled back and Zillow was looking like this looks like an awesome entry because it lines up with this support that we've previously outlined at this level. But as I mentioned earlier, I'm treading cautiously on a week-to-week basis. I don't want to get too wrapped up into, what I would consider long, smart plays like this one where you would be happy long-term investing in a stock like this. So that is my spiel with Zillow right now, and I think it is equally applicable to what's going on with Redfin, which I just horribly butchered the spelling of the ticker right there. But yeah, very similar charts, similar support levels. And to be honest, this 43, 44 level almost looks a little bit better than that 85-ish level on Zillow. And it may be easier for Redfin to get back to this 44 level than it was for Zillow to get back to the 85 level. But, nothing wrong with getting in around here, right? Because when I say I like the 44 support level, if you sell a 50 strike put and get assigned, you're already at 48. If you take that 48 basis on that assigned stock and then sell a 55 strike call, you're already down to 46 basis, which is, decently close to that mid 40s level. and you would still have potential upside to 55 come October. So, that's really not too bad at all. It's not going to be as exciting as any of these IV reversion trades, but I think it's super important to have diversity of companies and diversity of strategies in your portfolio as well. And when I say diversity of strategies, I'm 100% option selling, but I think diversity in the way that we make these option selling trades, right? We could look at this one as a traditional HT wheel where we just purely sell a cash secured put at a price we're happy with. If we take assignment, we take assignment. We go to the next expiry. We sell covered calls and keep the trade moving. That's one type of diversity we have in our portfolio where you compare it to other areas, like with what we had last week with our IV reversion type trades. So that's another type of diversity in practice and strategy that I like to reference in our portfolio. And then we'll also have some earnings trades. And if we take a look really quickly, we could pop over to our Discord server, which if you are watching and you haven't joined our Discord server, now would be a really good time to come join us. Here we go. And if you join HT Premium, another quick plug while we're here, right? Two birds with one stone. You'll get all these channels. You're going to get all of our trades as we alert them. And as you can see in the winning trades channel we have right here, a lot of people have been making some decent money. We're following each other. I mean, I call out a lot of trades, but other people call out trades as well in these channels. So it's super, super helpful. But I'm burying the lead a little bit here. So let me go to the earnings plays where we've posted the screenshot of what's coming up for the next week. Honestly, not a super heavy week from an earnings perspective, so there isn't a ton to look at. Obviously, GameStop is a name that sticks out right there just because of the crazy price action that stock has typically had, and earnings might bring a little more craziness, but not something that I'm personally involved in, so I'm going to leave that one alone. Affirm is a decent company, but they just had a really big spike, so entry on that one might not be the greatest. But outside of that, I'm just really not seeing, maybe other than Lululemon, anything that I'm terribly interested in. So, I mean, come Wednesday, we say we like to only play earnings that report Wednesday afternoon or later in the week because that allows you to sell weekly options that expire very, very quickly. So you get not only the crush from the implied volatility, but also the super rapid theta decay at the end of the week. So we're going to hold off on that, and if anything happens, we'll be sure to alert in that earnings plays channel about what we decide to do for earnings. But with that said, we talked a little bit about what happened last week. We're very, very light right now, and I think what we've done so well over the past month or two on a week-to-week basis is, it's one thing to come into a week with a list, and I think we have a decent idea, right? We went in with Clover, we went in with CRSP, we have FFIE headed into the week, and I think those are three where you still are able to enter into those if you're not in on those yet. But then we've got some things like, what was it, JBOY that what did we look at? JOBY, there you go. I mean, helpful to remember. This one looked like a really decent entry on a week-to-week basis. We still have that free trade from ZEV that we called out in our main Discord server last week. I mean, some of these are going to keep rolling on a week-to-week basis. But, back to the point I was trying to get to is that what we've done so well, I think, over the past month or two, which has allowed us, quite frankly, to have this really well-sustained streak of profits, is we've reacted on a day-to-day basis. And it's great to have these trades working in the background on a week-to-week basis because we picked up profit from CLOV, CRSP, SOL, FFIE, SKLZ. Those gave us a really nice profit base to work off of. But what really brings your week from like a small conservative week to the next level to where you're pulling a 2% return in a week are the trades like ANY, the trades like ACIU, even though that one didn't win, but trades like SPX, CRSR, where we have these IV reversion trades or trades that we're making in response to developments that we see in the market. So that's why I think that Discord server that we have is super, super important. We call everything out as we see it. And, we can't always have our eye on the market, but we've got enough people in where others are going to have their eye on different things. So I've gotten a lot of great ideas from you guys as well. So it's equally helpful. And I hope we could, build off of each other's ideas. It's not a zero sum for us when we're selling options, right? We're not moving millions of dollars around. So we could all enter these trades and win it together. But that is the benefit of the Discord server, and that's really kind of the game plan as we head into next week, as we are only using, we're using less than 20% of our buying power, and I feel like every single week I've said, this is the least buying power we've ever used. This is the least buying power we've ever used, but again, we find ourselves in a situation where this is the least buying power that we have ever used headed into a week. So we're going to have a lot of flexibility. We're going to take advantage of that flexibility by being patient and waiting for good entry opportunities. And of course, we are going to alert those entry opportunities as we see them in our server. So I think that kind of is everything that I've got for tonight. We're at the 1.5 hour mark on the stream. We're going to cut it off right here because it's already 11:30 Eastern. It was a little bit later, I guess, because I started at 10. That definitely makes sense. But at the end of the day, sneaking up on me. So thank you to all of you who joined in tonight on the Labor Day edition of our weekly trade ideas. If you're watching on Twitch or YouTube and have not, followed or subscribed, feel free to do that. We've got the links in there on the videos, and I think on our Twitch channel, come join our Discord server. So if you're not part of that with us already, feel free to come join us. It's perfectly free to join, but all the premium stuff is extra, but it's always free to learn and talk about the strategies that we use. So I think there's still a lot of value, even if you don't take the premium avenue. But with that said, I'm going to do the same corny outro that I have on all of these streams saying, this has been the Hourglass Trader, where as time passes, we make money. Thank you guys, and hopefully we will talk to you again 6 days from now with another green week in our pockets. So thank you guys so much, and we will talk to you on the Discord server. See ya.